A very good morning from India to all our listeners on this webinar on new payment systems and inherent anti-money laundering risks, jointly hosted by Fintelekt Advisory Services and the Asian Bankers Association. I'm Arpita Bedekar from Fintelekt Advisory Services, a company focused on research, training, and advisory in the AML and CFT space within Asia. It's my pleasure to be your host for today's webinar. Our agenda is straightforward. We will engage in conversation with our two guest speakers, Russell Wilson, Special Counsel Maddocks and Non-Executive Director of Transparency International Australia, and N.M. Eftakharul Bhuiya, Head of Legal and Compliance and Company Secretary at Nagad, a rapidly growing digital financial services company based in Bangladesh. This will be followed by a question-answer session. You can type in your questions for the two experts on the chat window that you see on your screen as we go along. Before we begin our conversation, let's take a look at some of the developments within payment systems. Fueled by the availability of high-speed data networks across the world, increasing mobile penetration, technological innovation, and changing consumer behavior. By new payment systems, we are referring to the recent wave of digital payment mechanisms such as credit and debit cards, internet banking, mobile wallets, digital payment apps, payment interfaces, etc. The volume of digital payments is soaring, and some estimates suggest that by 2020, it is likely to approach $5 trillion worldwide. Asia Pacific is a dominant region in this global payments revenue pool and will continue to have a lion's share in growth and innovation. As a result, there is rapid growth in volumes across e-commerce, mobile wallets, SME businesses, and an increase in competition among providers of these payment services to get both the existing business as well as to reach out to new customers. An area that is being talked quite a lot in this context is that of financial inclusion, or bringing the unbanked and underbanked populations into the financial system. This is in fact a clear focus area for governments and regulators in many countries, and something that is becoming increasingly possible due to innovations within the financial services industry. However, the flip side of this rapid growth is that new and unknown risks are emerging around money laundering and terror financing, especially due to the real-time nature of transactions and the speed at which organizations have to react in terms of their AML and CFT efforts. Some known money laundering and financial crime typologies are already emerging. Online marketplaces, where fake bookings are made or fake products could be sold. Cryptocurrencies, we are all aware, largely due to the anonymity and global nature of transactions. Transaction laundering, in which illicit players use the credentials of an approved or legitimate vendor to reroute transactions. There are online casinos, gaming sites, auctions, lotteries, and gift cards and prepaid cards which are used to launder money. So how do organizations react to this? The goal for the financial crime compliance community is to be ahead of criminals at all times. But for regulators, the worry is that the chain of processes behind each payment is becoming so complex that criminals might be able to hide their illicit transactions very easily. Today on this webinar, we would like to go ahead and discuss some of the regulatory approaches, the AML challenges, and mitigating responses that companies can put in place in the face of these AML risks. Let me now go ahead and introduce our guest speakers for today. Russell Wilson, Special Counsel Maddocks and Non-Executive Director Transparency International of Australia. Russell has over 32 years post-admission experience as a lawyer. He is the former General Counsel and National Manager, Legal, Governance and Risk of Austrac. While at Austrac, Russell led the last mutual evaluation of Australia for the agency and also the statutory review of the AML-CTF Act of the country. Post-retirement, he has been advising on AML-CFT issues with a private law firm, particularly in regard to digital currency exchanges and remittance services. The second speaker for today is N.M. Eftakharul Bhuiya, Head of Legal and Compliance and Company Secretary, Nagad, Bangladesh. Eftakharul has a broad legal background with more than 12 years of experience in fintech, telecom, M&A, employment, and finance matters. Before Nagad, he was the acting head of legal department of Bikash Limited, the largest mobile financial services provider in the world. He also worked as in-house legal counsel of Grameen Phone Limited, the leading mobile operator of Bangladesh. He's an advocate of the Supreme Court of Bangladesh and has been representing clients in different courts and tribunals. He has an LLB honors and LLM in commercial law from the University of Dhaka. So my first question is to you, Russell, on what are the challenges to effective regulatory oversight and supervision in the area of new payment systems, given that the risks are global while regulation is largely territorial?
There are a number of challenges, but for current purposes I will mention three, focusing on oversight and supervision, on the assumption that there are various risks. I will speak more about some of those risks later. Firstly, the question itself describes a major challenge. Regulation is based on the jurisdiction of nation-states, whilst new payment systems use technology which has no territorial boundaries. There have been global payment systems operating for a while, such as MasterCard and Visa, which are linked to cards. But these have worked within the traditional financial system and importantly therefore required identification checks for access to be granted to customers. The risk was increased with the emergence of PayPal as an online payment platform, but regulators met this challenge by requiring PayPal to comply with the AML rules, including customer identification. There followed a number of other payment systems not linked to cards, such as Amazon Pay, Apple Pay, Alipay, WeChat, and Google Pay, though these are all linked to an account with the financial institution. Even the proposed introduction of Libra, whether in 2020 or at a later time, is likely to follow a similar path in regard to identification and verification of customers and ongoing customer due diligence, at least according to Facebook. However, some cryptocurrencies, such as Bitcoin, do not play by these rules, as they allow anonymity both in their ownership and their use. They are designed for this purpose and to circumvent the traditional financial systems. They can be used to move value globally with the press of a mouse button. Regulators can only hope to identify their users when the cryptocurrencies are exchanged for fiat currency or vice versa. The former only need happen when their owners cannot purchase what they need using the cryptocurrency or to cash out the investment. A second major challenge is that whilst the Financial Action Task Force's recommendations are recognized as the global anti-money laundering counter-terrorism financing standard, not all countries have signed up to these recommendations, and FATF's enforcement of them is a bureaucratic process, relying on action by member countries akin to sanctions. To its credit, FATF has sought to modernize its recommendations to keep pace with technology. In October 2018, the FATF adopted changes to its recommendations to explicitly clarify that they apply to financial activities involving virtual assets, and also added two new definitions in the glossary: virtual asset and virtual asset provider. The definition of virtual asset is, quote, a digital representation of value that can be digitally traded or transferred and can be used for payment or investment purposes, end quote. This is a fairly wide definition that will catch value on mobile payment platforms. However, the definition goes on to exclude digital representations of fiat currencies, which may be an issue once this begins, as is now anticipated with China. A third major challenge I would like to mention is the lack of consistency and compliance with the FATF recommendations for those countries who have agreed to comply with that framework, and the lack of global coverage as some countries have chosen not to join. Once a person gets into the digital ecosystem via a weak jurisdiction, or a jurisdiction that doesn't even seek to comply with the FATF recommendations, then they will have the capability to transfer value globally, leading the way for digital havens similar to the current tax havens. Even in Australia, which has recently legislated to cover digital currency exchanges, the platforms on which digital currencies may be exchanged or exchanged for fiat and vice versa are not regulated, illustrating the difficulty for national regulators to regulate a platform operating over the internet which servers can be moved anywhere in the world. Few countries are prepared to assert extraterritorial operation for their laws, but this could happen more often in the future. Related to this, FATF's system of assessing compliance with its recommendations through mutual evaluations also leads to inconsistency in outcomes, an issue identified by FATF in its internal debates over whether or not to have these mutual evaluations done only by professional evaluators. These are just a few of the challenges. I am glad you have not asked me for the solutions. I haven't even touched upon taking compliance action across jurisdictions.
Thanks, Russell. And clearly the role of the regulator in today's time and age is quite unenviable. But what really should be the role of the regulator in the context of the emergence of new payment systems? Should they be aggressively enforcing regulation or assume a wait-and-watch approach and intervene if necessary?
My view on this is based primarily on my 10 years with AUSTRAC as its first General Counsel between 2006 and 2016, during which time I also undertook a number of other additional roles, including leading domestic and international policy and rule drafting. I was responsible during that time for AUSTRAC's response to the full FATF mutual evaluation of Australia, as well as, at the same time, the statutory review of the domestic AML CTF regime. I therefore had a great deal of involvement with other domestic and international regulators, as well as industry participants. My role also included advising on whether or not a product or service fell within Australia's AML CTF regime, and on appropriate compliance action for breaches of the regime. In my experience, the role of the regulator in the context of the emergence of new payment systems should not be to aggressively enforce regulation by default. That is not to say that where the evidence justifies that action should be taken, that it should not be taken. Each case depends on its particular circumstances. But a regulator does not work in isolation. Apart from maintaining constructive communications with other domestic and international regulators and other sources of intelligence, a regulator must also work with its regulated population, which is not homogeneous, to reach good regulatory outcomes. A one-size-fits-all approach is unlikely to achieve such outcomes and may result in waste of public money. Much has been made recently in Australia of the so-called Banking Royal Commission and the comment that came from it that regulators should litigate by default. I do not believe that this is universally the case and should always be based on sound evidence which, in this field, often comes from reliably sourced and verified data. A major consideration for governments, who are often competing for global talent in this respect, is for regulators not to dampen innovation by their actions. This becomes a consideration for regulators when exercising their discretion as to what kind of compliance or regulatory action they might take, with the outcome that they may take less aggressive action initially and seek to work with the regulated entity to rectify deficiencies. Related to this is that regulators are not necessarily aware of the nuances of how new payment systems work and how they fit into the regulatory scheme they administer. It may be that there are questions about whether the activity fits within the regulatory scheme at all, and if so, how. In such situations, regulators are likely to take a cautious approach and tailor any regulatory action accordingly by seeking to obtain further information before deciding on whether or not to take coercive action. For example, first requiring an independent audit to be undertaken to see whether or not the activity has infringed any regulatory requirements. A consideration for all governments is that the use of digital payment platforms will enable them to track and regulate the flow of funds much better than the use of cash, as long as the government can access the relevant information. The primary aim of restricting the use of cash as is happening in Australia, is to identify tax evasion, but it is also useful to counter one means of money laundering. An example of the policy difficulty faced by government in balancing competing considerations is the situation in Australia where it proposes to ban the use of cash of $10,000 or more, but is also proposing that this restriction not apply to digital currencies. The efficiencies a cashless society provides may also boost general economic performance. I've so far spoken about regulators in the financial services sector. There is another important regulator which can influence how payment systems can operate globally. This is the regulator which has jurisdiction over the collection, storage, and disclosure of personal information. In Australia, this is the Information Commissioner, and there are rules under the Privacy Act about transfer of personal information overseas. The Privacy Act has extraterritorial application if there is an Australian link or the act or practice is done or engaged in by a government agency. Given the different privacy rules that apply globally, for example, the General Data Protection Regulation, which applies in the European Union, the lack of any federal regulation in the United States of America and differing state laws there, and Australia's laws which are different again, there is no global consistency to enable privacy rules to be used as a lever to regulate payment systems.
Well, thanks, Russell. What are the initiatives that you have seen from regulators in Asia in recent times to provide the needed flexibility for e-payment systems to gain traction?
Central banks and regulators in Asia have generally been more flexible in their approach to e-payments. This has allowed Asia to some extent to lead the world in the transformation of payment systems. This has happened not just in countries in which there are large rural populations without access to the banking system, but with significant mobile phone usage, such as Bangladesh. It has also happened in large cities such as Beijing, Shanghai, and Shenzhen, simply for convenience in making payments, such as public transport fares. A mixture of demographics, technology, and competition has led to significant adoption of new payment systems in Asia. Some examples are WeChat Pay and Alipay in China, which have been used for a while to pay public transport fares, medical services, utilities, traffic fines, and in retail stores. These are now spreading to users outside China and may do so further via the One Belt, One Road initiative. The Unified Payments Interface in India that enables money to be transferred between mobile phone services and bank accounts. This is related to the decision of the Indian government to withdraw high-value banknotes from circulation in November 2016. Some of these payment systems have been based on QR codes, such as the Singapore Quick Response Code and the Interoperable Credit Transfer Framework in Malaysia. These are government initiatives that assist with unifying fragmented e-wallets and facilitate interoperability. Another example of this is Bangladesh's Access to Information program, which, as in India, will also serve as a platform for citizens to receive social welfare payments. Some payment systems have been attached to the popular WhatsApp messaging platform. Others have involved cross-border collaboration, such as the Bank of Thailand cross-border funds transfer arrangement with Cambodia, Laos, Myanmar, and Vietnam to reduce the price of money transfers. These are just a few examples of initiatives that have been happening across Asia for a while. None of this could have happened without flexibility on the part of regulators, some competition, but also collaboration between countries, and acceptance, whether informed or otherwise, of a digital identity. This does not mean that there are no risks or challenges. One significant downside is the risk of fraud or other criminal activity in the allocation of a digital identity. It remains to be seen whether the use of e-payment systems will grow in popularity at the expense of cards or cash, but there is clear indication from governments to regulators of the benefits of e-payment systems.
Thanks, Russell. Which brings us to the issue of financial inclusion and a broader adoption of which is central to the success of new payment systems. How can countries effectively balance financial inclusion priorities with the inherent AML risks?
Prospect of greater financial inclusion and reduced costs has been a major selling point for new payment systems. The Libra digital currency proposed by Facebook is a good illustration of this. It is likely to be most successful initially in less developed countries where there is a lack of access to financial services but high mobile phone usage. It is likely to be popular in highly remittance-dependent countries such as Philippines, Bangladesh, Nepal, and the Pacific Island nations, as it will significantly reduce the cost of remitting money to these countries. At the same time, it will introduce the digital currency into these financial systems. The AML risk of such a digital currency will depend to a great extent on the carrying out of customer identification and customer due diligence. If, as indicated by Facebook, the dissemination and use of Libra will comply with local AML rules based on the FATF standards, then AML risks were mitigated to the extent that current rules require. The same is true of other new payment systems. If in the course of complying with the AML rules, the provider obtains ever more personal information and seeks permission to share it with related organizations, then isn't this a matter of individual choice? Or should governments intervene to protect the citizen, even though governments may like access to that same information for its own purposes and may find a means of acquiring it? The balance between the financial benefits of new payment systems and the risks is likely to be different in different countries based on the nature of the political system and the confidence of the government in its approach. What is clear is that the global system of AML regulation is only as strong as its weakest link, particularly when it comes to new payment systems. May I finish by thanking Suresh and Arpita for inviting me to participate in this webinar. I hope my contribution has been useful.
Thanks so much, Russell, for your views. Let's now turn to Eftakharul. Eftakharul, given your company's rapid growth within Bangladesh, what are some of the due diligence challenges that you are facing as a fintech and a real-time payment service provider?
Thank you for asking me the question. With the rapid growth of the company and the entire fintech industry, the fintech business is exposed to different types of due diligence challenges. For example, lack of awareness among the customers is the prime concern for us. The unbanked population who are not familiar with the banking documentations like KYC requirements, how to fill in the KYC's STR process, these are the prime challenges for the customers. So this is very difficult for us to educate the uneducated people. Secondly, lack of awareness among the channel partners. The channel partners are also not aware of the due diligence requirements and the necessity of keeping these. So it is also difficult to educate them, and as they are not from the financial industry, they are also not aware of the significance of keeping proper record, notifying or reporting suspicious activities to the regulator. Also, they are not capable of taking risk-based approach. Next is competitors. Any compromise on the due diligence requirements by any of the competitors may impact the industry. So it is very important to align the industry on the due diligence requirements. Technology-driven industry is another challenge for us because we use self-registration, instant validation, OTP verification, educating customers through app notifications. So these are the strength of our industry. At the same time, this could be our challenges because a larger portion of the populations are not tech friendly. People are reluctant to update their personal information like addresses, transaction profiles, source of funds, etc. Mode of communication could be the last point. It is difficult to interact with the massive customer base actively. Most of our communication channel is passive, like we use SMS, leaflet, trade letter, booklet, brochures, sticker, etc. for communication purpose. And these are communicated through third parties. So it becomes challenging to educate the customers and other concerned stakeholders.
Well, thanks, Iftikhar. My second question is, so what are the AML risks that you're facing by likely relaxing compliance requirements to meet financial inclusion goals? And how can these be mitigated?
Well, as you know, Nagad service has been introduced by Bangladesh Post Office. So, to ensure the reputation of Bangladesh Post Office, we have to be very concerned about the AML safety and other associated compliance risk of the business. Moreover, the rules and regulations here in Bangladesh are very precise. So, as a financial organization, we have to take the responsibility of ensuring a safe and secure environment to combat money laundering and terrorist financing. FATF suggests a risk-based approach to customer due diligence in order to ensure financial inclusion. Therefore, Bangladesh Financial Intelligence Unit have accepted a simplified KYC to onboard mobile banking customers. Mobile banking service providers of Bangladesh follows the simplified KYC to onboard the customers accordingly. However, due to the mobility nature of our services, miscreants will try to abuse the platform if the compliance requirements are being relaxed to ensure financial inclusion. For example, scope of identity theft will be increased at a larger scale, and thus fake account will be created using other person's identity documents. Fraudsters and criminals will tend to abuse the platform for their own benefit as the customer due diligence requirements are being set by the regulators. So the regulator may impose sanction on us uh, as to why the compliance requirements has not been obliged. It will be difficult to identify the fraudsters and to report the same to the Financial Intelligence Unit as fake accounts are being created. STR and SAR reporting process will be hampered. Compliance expenditure will be severely increased. To prevent the said risk and to keep the reputation of Bangladesh Post Office intact, these challenges can be mitigated by taking some of the steps. Number one, by verifying the customer's identity through National Election Commission's database, which we are doing right now. Just for your knowledge, we have an authentic database of the citizens of the country, and we have access to verify our customers from that very database. Number two, awareing the customers and channel partners so that they can refrain from fraud and money laundering and terrorist financing related activities. Let me explain some of the activities that are being carried out by Nagad in recent times. For the customers, we have opted indirect communications method like fraud awareness SMS, push notification, social media campaign, leaflet, banner, poster, putting awareness content in the transaction register book on which they keep their transaction records. For the channel partners, the awareness activities are more rigorous to educate and aware the channel partners. We are conducting AML safety training throughout the countries. We are providing leaflet, trade letters, POSM materials, SMS notification, push notification through the app, etc. to aware the channel partners. Third is transaction monitoring, which is a key activity to ensure AML CFT compliance. Customers can be monitored on a regular basis based on different risk criteria. Some of the risk criteria can be transaction profile, volume and amount of transaction, accounts registered in risk-prone area, nighttime transaction of same amount of money in different accounts, transaction of accounts registered using other photo ID, for example, passport or driving license, transaction of agents in risk-prone area, unusual transaction of any agent in comparison with other agents in that specific area. Fourth is investigation against any reported incidents. These incidents can be reported through different channels like customers, law enforcement agencies, courts, FIUs, or other stakeholders. Any incident reported should be investigated so that any common pattern is determined or if any syndicate is involved in such incidents. Fifth is compliance visit. Based on the reported incidents, investigation reports, fraud and crime patterns, a compliance visit should be carried out in the risk-prone area. Sixth is STR or SAR reporting. If the customers or channel partners are found to be involved in suspicious activities, STR or SAR should be reported to the concerned authorities for the mitigation of AML risk.
Thanks, Eftakharul. So let me ask you, what would be your expectations from regulators and banks for a seamless operational environment?
Let's discuss the expectations from regulators first. Fintech is the ultimate future of banking, as per my understanding. So, regulator can play a vital role to ensure the financial inclusion and to ensure a better service for the customers. At present, the interoperability of the mobile banking users should be taken prime consideration. The interbank transactions in Bangladesh has observed a significant development in recent years. BFTN, NPSB, RTGS have smoothened the financial transactions among the commercial banks and financial institutions. Through any of these services, customers can enjoy quickest services ever. Similarly, if interoperability among the mobile banking service providers are authorized by the regulator, this can ensure financial inclusion in a more efficient way. Let's discuss the expectation from banks now. Banks and mobile banking service providers go hand in hand in providing the services. Mobile banking service providers are valuable customers for the banks. Also, they are strategic partners. For example, in introducing push and pull services between banks and mobile banking service providers, this will ensure a better financial inclusion for both the service providers' customers. This way, the customers of banks will be eligible to send money from their banking accounts to mobile banking accounts or vice versa to ensure smooth usage of money. This way, both banks and mobile banking service providers can increase their revenue and satisfaction of the customers.
That's interesting. Thanks. So, how can financial institutions utilize technology to strengthen the safeguards against MLTF in real time payments?
Technology can play a significant role to strengthen the safeguards against money laundering and terrorist financing in real-time payments. How? Right? Firstly, by ensuring due diligence process, which basically ensures the authenticity of a customer. In our case, we have introduced digital KYC registration process for customers, which has reduced our time, effort, and financial expenditure. Let me explain how it works. The digital KYC registration process or DKYC registration process is the scope through which registration can be done in a just couple of minutes through agent or by the customers himself. Registering directly by the customers without any assistance from the agent is very popular here, and that is called self-registration. In any of such registration, accounts shall have to be registered against customer's own national ID card. The OCR technology shall extract data from the national ID card during the registration process, which shall be verified instantly through Election Commission's database to ensure the authenticity of the NID. If this is valid and the information provided by the customer matches with the database, the account will be created in just a couple of minutes. Once the information is matched, the accounts are turned into full profile for regular transactions. It usually takes 10 minutes. However, our commitment to customers are less than 48 hours. In the process of reaching operational excellence, we have introduced another software called Porichoy, which is a state-owned software used to verify customers' information from Election Commission database. The Porichoy software has reduced the time of account registration in a significant way. Now customer can register themselves in just 1 minute. Secondly, UN and other relevant sanction lists should be screened. Any service providers who have any service providers who are screening UN sanction list and other relevant sanction list applicable to their jurisdiction can ensure that no blacklisted entities are abusing their platform for terrorist financing or money laundering purposes. Thirdly, transaction monitoring. Transaction monitoring is a mandatory requirement for the financial institutions. The purpose is to ensure the platform is not being abused by any miscreants for money laundering or terrorist financing or any fraud issues. Technologically, real-time flag raise can play a vital role. Any suspicious transaction based on predefined criteria can be blocked instantly, or to authenticate any suspicious transaction, a certain time break between two transactions can also be implemented to reduce risk. Fourthly, authentication of identity through technology. Transaction through face detection or voice detection has already been implemented in some of the developed countries, which has reduced fraud risk in significant way. So that's how technology can have a severe positive impact on the financial transaction and financial.
Thanks to Russell and Eftakharul for sharing their knowledge and insights today on this webinar. Thanks very much to all the listeners, and I hope the webinar has been useful for you. Uh, we'll have a link to a very short online assessment which will be circulated by our partners, Asian Bankers Association. And those who attempt the assessment will be eligible to receive a Fintelekt ABA participation certificate for this webinar. We will also be sharing the slides, and the recording for this webinar will be available in due course on our website. Also, the calendar for webinars in 2020 will be out shortly on our website, fintelekt.com. Do sign up for our mailing list on our website if you are interested in receiving notifications about our upcoming events and training programs. Once again, thanks for joining us today and wish you a very pleasant day ahead.